All right, so I've titled my talk, Why Inflation is Not Transitory and the Great Crossover is Underway. By the Great Crossover, I'm talking about the move from fiat money, from money that is required by law to use, to money in which the market requires under circumstances of, that I think we're heading into. That people will once again require honest money and not money that can be created infinitely by central bankers. A book that I think is well worth reading is called The Fourth Turning. It's written right before the turn of the century. Just very quickly, the thesis is that every 20 years you have a turning. People start to think differently every generation. And every fourth generation, when you have four of those spanning 80 to 100 years, you have a major turning point in history. And the way I look at it is this is America's fourth turning. So I think it is a huge event that is starting to take place in America, and it will have ramifications for economics, for how we live our lives, but for markets as well. The fourth turnings, the first one was 1776, when the American Revolution, and there were certain views and attitudes that were different from the King of England, and that's why we separated. And then there were these other cycles. 1860, the Civil War was the second turning in American history. The third was the 1930s through the Great Depression, and the fourth arguably started with the financial crisis and the election of President Obama. So it's very important because I think the very philosophical view of America when it was created was one for liberty, for freedom, for the individual to be free of government. The idea, the philosophy was that we have our rights that are granted by God, not by government. And that makes all the difference in the world. If you believe that your supreme being is your president or your, whatever your whatever your primary government is, if you think that you owe your allegiance to them, then you will behave much more differently. And I would say that what America is moving is from free market capitalism to corporatism, or an uglier word is fascism. But the definition is there. The idea is that when corporations and governments are in bed together against the people, essentially, to get rich and to increase the power of the politicians. I think this is very much what's going on in America right now, that the large corporate interests are really in charge and are calling the shots more and more. I mean, things like pandemic lockdowns, forced vaccinations, censorship of political ideas in America now are being censored to a very great extent. Censorship of scientific ideas that are from qualified scientists are not allowed to speak or shut out by YouTube and so forth. So these are things that I think are very, very different. The ideas of the Federal Reserve, of course, the Federal Reserve is not new, but it has essentially has really kicked into overdrive, as we will see when we go through this talk. The Federal Reserve is now in a very difficult position. They have to print more and more money faster and faster to try to keep the system from imploding, from going over the edge. So I'd like to say why I think inflation is not transitory. This slide is a little out of date, so I just posted the last CPI at 6.2%. It shocked the markets, and a good discussion by Eric this morning. The impact it had on the gold markets, I think, was very good. But so here's some of the reasons that I think inflation is not transitory. First of all, we have this excessive level of debt. We can't allow interest rates to rise, so they have to keep pumping more and more money into the system, that's inflationary, to keep the rates from rising. And if they allow rates to rise just a little bit, just a couple percentages or so, the system will go over the cliff. And the government will have trouble financing its debt as well. So the Fed is going to be forced to decide between a deflationary collapse or an inflationary prolongation of the current system, of the current economy. So federal deficit as a percent of GDP. Well, we know with COVID what happened, but they're still very, very large. And we have a liberal administration, an administration that is more socialist, that wants to spend endless amounts of money and sort of redistribute income through government payouts. And I think that one thing that we will be watching pretty closely will be the elections in the states, because if the Democrats continue with both houses of the legislature, then I think it will be, there will be less restriction on the creation of money, and the inflationary fires, I think, would burn brighter. But I think that, the recent elections are suggesting that there may be somewhat of a backlash against the far left movement from AOC and some of the extreme members of the Democratic Party. Deglobalization, I think, is a big factor now as well. And talking to Chen Lin the other evening, over dinner last evening, in fact, he was talking about how the Chinese have cut back on their iron production, their steel production, and that has really caused them to make huge amounts of profits. And so with the trade wars started by Mr. Trump, continuing with the current president, we expanded the global economy when we expanded globalization, but now it's running in reverse. So this is creating, of course, a shortage of supply in many sectors. And of course, also there is the aspect of the supply chain issue. Rising energy prices we have, I think, in part in the U.S., in large part by the Democratic Party policies. The president cutting the pipeline from Canada down to the U.S. He's threatening to cut another pipeline from Canada, I think, through Michigan. So it's the Green New Deal that is causing, I think, part of the problem, in addition, of course, to money creation and lots of money that's being put into the system to keep things moving forward. I think this is the first time in my lifetime since the 1970s, when I was a young man, that I can remember labor having the leverage that it has now. I don't think that that's going to go away right away, especially if the Democrats continue to control the government. I think we're going to have more and more transfer payments, which means they have to be paid for by money printing, because there's not enough taxes to pay for all the spending. We're running these huge deficits. So we're seeing a lot of wage inflation, and strikes are back. Just an awful lot of strikes are taking place. You can see the numbers there. John Deere, Kellogg Cereal, Kaiser Health, 60,000 behind-the-scenes movie and TV workers were striking for a short period. Anyway, there's a long list of labor now has the power, and especially with checks going from the government to the workers, that has really also emboldened them and given them a great deal of power. So debts, well, with COVID, we see the big spike up in debt to GDP. And so compared to the old projections, it's just really skyrocketed. So the debt is really very, very worrisome, projected to get out to, if I can read, 121% of GDP in the out years, but it's already, well over 100%, about 110, close to it. The problem that we have now that we didn't have earlier in my lifetime was that foreigners have stopped financing America's consumption. And this is the new Treasury debt recently issued, and you'll see the major amount of it was purchased by the Fed. And you had some pension funds that have to buy as well. But for the most part, the other people, the banks, the households, other people are gone. Foreigners, that's the most important one. The net export countries were recycling their dollars back in to buy treasuries. That's no longer happening. That means the Fed has to print money. That's inflationary. So here's a chart just showing how foreigners are dumping dollars. It's pretty massive, and they're decreasing the dollars that they're holding, and they're not buying new treasury offerings to the great extent they were. If you think that foreigners don't have a lot more to sell, they do. This was the latest slide that Alistair MacLeod from Gold Money presented in his newsletter. So total liabilities of something like 32.7 trillion, all sectors. So foreign money, if they lose confidence in the dollar, or they have needs at home for whatever reason, we could have a huge number of dollars dumped into the system, which could be very harmful to the dollar. Not even the United States government is buying its treasuries for Social Security, people like me. So there's no reason to buy the dollar when you're so deeply underwater compared to inflation. When you have such high negative rates, it's financial suicide to buy the dollar. The other thing is that the laws of economics cannot be repealed by politicians. They can try, they can suppress, they can pass laws, and they can manipulate markets as they do all the time. But this shows the 10-year yield, and it's starting to rise. And this was before the latest CPI numbers. So it is arguably the 10-year yield is starting to rise. And the Fed will no doubt try to do what they can to suppress the long end of the yield curve, but it's very difficult to do. And people will step outside of the system and do other things, or they'll just simply, well, the Fed will have to buy more treasuries if no one else is. I mean, the rates have to go up in order for economic reality to be restored. Now, I'm just going to play this quick clip. This is really a very interesting discussion between Danielle DiMartino Booth and Adam Taggart recently. And I think, could I ask you to play the clip, please? It's about a 3-minute clip.
This is a chart of the Atlanta Fed's GDP Now graph, where they track GDP in real time. And it shows a precipitous drop where they were projecting over 6% GDP as recently as the end of August. It's now plummeted to 1.2%. When you have a slowing economy like this, but you've got rising inflation, which wins? You know, do you think, which do you think will win policy-wise? Do you think the Fed will have to taper and maybe raise? Or if the economy slows enough, can they just not do that? It's just not politically palatable.
The stock answer to the question, which you're asking, is the Fed going to commit a policy error? And the answer is yes. No matter what they do, the answer is yes. You cannot tighten into an environment in which you have all of these zombie firms that rely on the high yield markets, the capital markets staying wide open for business just to keep the lights on, because their cash flow doesn't cover their interest expense. So they have to constantly turn over their debt. So you cannot hike rates into such an environment. You cannot hike rates in an environment in which the United States debt load is pushing $30 trillion. And yet you cannot not hike rates when inflation is out of hand as it is. Companies are trying to deploy mitigating efforts, which people don't really understand, to get wage inflation under control. And I think the biggest risk right now to the economy that nobody is talking about is the specter of millions of jobs having been eliminated forever, permanently, automated. The idea of accelerated automation is not being discussed enough by the broader media inside of the macroeconomic community and circle, and people just seem to think that because their time has come, employers are going to roll over and play dead and just pay up and screw the shareholders. It's not really how things work. Is there a massive divide and disconnect between how corporate C-suite executives are compensated and how their employees are compensated? Absolutely. Should the minimum wage have a 7 handle? No, it should have a 10 handle. We get that. 15, not so much in Mississippi or Texas where I live. So there are major disconnects between employers and employees, and I get that. But we would see more dynamism in the labor market. We would see more job creation. We would see more of the, oh my God, there's 10 trillion job openings. The sky is absolutely falling. Wages are going to the moon. We would see more of those openings being filled if companies truly had the need, unless there was a separate factor going on in the background, which is very apparent when you look at what companies are spending on IT and on automating, and it's right there in the GDP figures, right in front of your very eyes. So people cannot appreciate that there may be millions of jobs that were lost in the pandemic era that are gone forever.
Okay, so that's Danielle DiMartino Booth, who was the assistant to Fisher, the Federal Reserve board member. She had been his main assistant for a number of years, so she comes well qualified as a mainstream person, and she's pointing out that the Fed cannot win one way or another. Either it goes over the cliff into a deflationary depression, or we continue to spiral into an inflationary environment. And the further we go into the inflationary environment, the harder it is, the more painful the correction will be. So I think this is why I think it's not going to change. Of course, theoretically, the Fed could slam on the brakes like Paul Volcker did in 1980, when I had a 17.5% mortgage on my house, the first house I owned. But that's not going to happen this time. It can't happen this time. It could happen in the 70s because America had a far lower debt to GDP. It was a robust exporting country to a great extent, a manufacturing country yet, but no more. We cannot do it. So this is why I think we're headed for some very difficult times. And most likely, if you think the Fed will actually slam on the brakes, then go with the deflationary scenario. Otherwise, longer term, I mean, timing is difficult, but I think we're headed for inflation as far as the eye can see until something breaks. Just a quick chart of the gold market. Now, in nominal terms, the gold market looks like it's, it's okay, and it looks poised for the next breakout, and I think it is. I think we're ready for it. By the way, Michael Oliver, who I have on my show almost every other week, his number was 1825, a weekly close at 1825 for gold. I would imagine, I haven't checked in the last hour or so, that the markets are closed now and that we probably have seen well north of 1825, which he believes is necessary for the next major breakout in gold. However, if we look at gold in terms of the amount of money that's been created, we are at a low. We are almost as low as we were when gold was at $35 an ounce, and almost as low as we were when gold was at $250 in the early 2000s. And what happens and why is gold so low? Well, really, I think it's price discovery that's distorted by massive bank selling, massive future selling in the markets, which this was just on the 3rd of November, was this smackdown in a matter of hours by the central banks that pumped huge amounts of money into the system. So what could set the gold price? What could cause the next? Well, I think the market is starting to recognize. I think Eric hit on several of the points this morning in his talk. But what you have to realize is that we've not had a fair market in the gold price for some time. We've had long-term gold prices go up. They do. But in the short run, they can discourage investors for exiting dollars and going into gold. And that's what they've been doing. So we're looking at, this is huge amounts of, LBMA bullion is like 100 tons. It's just 1,500 tons of paper compared to 100 tons of physical. So the paper markets just keep distorting. They're pumped into the short end of they go short the market and the futures markets, and they knock the price of gold down. So what you're seeing as the gold price isn't really the price for physical gold, and it's distorted and it's screwing the miners and the prices that they get for their product. But that is about to come to an end because Basel III no longer allows for the banks to do this. They can't put these derivative assets on their balance sheet anymore without raising capital or without having the other side, the same instrument on the other side of the balance sheet. And this starts on January 3rd. It could be that the banks are already starting to, because we've seen repeatedly massive smackdowns that didn't work very well. The gold price would come right back up in the next hours or days. So I think they were the bullion guys, the bullion banks were losing control before this, but I think it's in part because of what's happening on January 3rd with the Basel agreements, which do not allow banks to carry derivatives on the asset side of their balance sheet. Alistair McLeod has written and talked a great deal about this sometimes on my radio show, and so it's something I think is worth watching. It could allow gold to really rise very dramatically. Now, I think Eric pointed out this morning that the gold miners' free cash flow. The gold miners are doing extremely well. They avoided the mistakes in other cycles where they paid way too much at the top of the market for new deposits. And now gold miners are showing free cash flow. This is after inflation. And they're the only one in the S&P 500 other than financials, some of the financials, that have positive real free cash flows. That's the only sector. So the gold miners, they're being more conservative. They're not paying crazy amounts of money for new deposits. And they've got really strong balance sheets. And they're ready to, I think, start buying gold mining companies. And I think we'll see some M&A activity in the not-too-distant future. Maybe you're already starting to see it. This is just a slide to show you that the S&P earnings yield is, it's negative now. So these high-priced S&P stocks, maybe they're seeing nearing the end. This is the GDXJ, or the juniors, versus inflation expectations. This is a very recent slide. It would probably need to be updated a little bit with the move in the gold shares in the last few days. But nonetheless, what we're seeing is in terms of inflation expectations, which probably have also risen since this slide was created, there's lots of room for the gold miners to go up, to keep up with this, was pretty well correlated in the past. The other message is that the gold miners are making lots of money, but they haven't made many new discoveries in recent years. And so I think some of the companies that are here, and one that we're going to be hearing from in just a moment, Amex Exploration, is a company along with Great Bear and a lot of others that are starting to develop world-class gold deposits. I think are going to make a lot of money for investors that are buying at these levels before the generalists start to buy the gold shares. So that's basically what I had to say. I think that my bias, I used to be a deflationist. My bias now is that we're heading for inflation that cannot be controlled. I think it's likely to spin out of control eventually. They'll try to do whatever they can, but there's not much you can do long-term to try to defy the laws of economics any more than the laws of nature. So I would say hang on to your gold shares, look for good gold mining stories.